it would be logic to expect the amount of non-performing loan to go up. But we're very, very far from 2008. We're all trying to draw parallels to something in the past, and '08 really isn't it. We have to look at an environment where really credit has become a little less available, but it's not entirely curtailed. And the price of it has increased, but not dramatically enough that it's going to create a tsunami of problems. So where we're at here from a refinancing perspective is you have to look at what were property values 5 years ago. And in many sectors, they were either similar to where we're at today or a little bit higher. So the need for additional equity certainly will be there. There's going to be a range, of course, of outcomes. You have more risk when it comes to the office business. You have much less risk when it comes to the logistics business, for instance, where asset values are a little bit more comfortable versus 5 years ago, and where demand for space is also more noticeable than it is in office. So it's really a question of choosing the sector. And a lot of people will say, well, retail, for instance, has to be a sector where a lot of challenges could come up, but it has declined so much in value in the last few years, and the pain has been passed so much in terms of operating fundamentals as well. The sector like retail is potentially going to do better versus other sectors, the mainstays like office and residential, for instance, that are still not fully either pricing in the pain or fully seeing the changes in the operating environment.
And just to explain further to our audience, can you just pad out a little bit more where the financing is coming from for many of these real estate companies? Is it primarily through banks, or could there potentially be other types of investors exposed as well?
Yeah. So it depends on type of investors. So the public companies, for instance, often make good use of unsecured financing. So the normal bond market, if you will, that corporate Europe makes use of course. For a lot of private investors, banks play an important role, but a number of other capital sources also available to the business. Think about the insurance companies, for instance, and think about lenders that are non-bank, that are non-traditional, that will play in the real estate business as well. So there's a range of possibilities. I think the investors that generally have the most ease at going through this kind of environment are those that have relationships with the broadest group possible of lenders.
Well, you did say something positive a few moments ago about some parts of the business being cash flow positive over the next couple of years. Which part of commercial real estate are you more positive on? Is it retail, warehousing, office space? I'm guessing it's not office space, but where do you see the opportunities?
Yeah, so retail is, I'd say, the most differentiated one, simply because it's been written off by most players in the real estate business. And as a result, the going in yields tend to be well above average. You can buy retail real estate at 6 or 7% going in yield, and you can enjoy cash flow growth in the 3 to 5 percentage point range. A couple of other sectors that are very interesting tend to be a little bit less at risk of changes in the economy. So if you think about the student housing business, it's an environment that we find interesting as well. It's counter-cyclical in many ways. Everyone will continue to go to school in order to upgrade their skills. The self-storage business is another one that we find very interesting. It's a business that has boomed enormously in the US over 25 years and is starting to take place in Europe. And in the European context, we have very, very little supply compared to what should become the demand over time. So the ability to push rents is okay in that business, and you can go in at a very attractive going in yield.